I just wanted to know the P.I.L.L method, what it means. Is it like an acronym or something? And how does that work? Because I keep hearing it, but is it something, that I have to wait, in the room to find out?
Oh, no, you can find out right now. P.I.L.L stands for Prepayment of Principal, Isolating the Principal Amount, Leverage, and Liquidity. We take these basic concepts and use this information in our opportunity cost calculator, which is a cloud-based, artificially intelligent computing platform that does all of the math and guides you and gives you information just like GPS, like a financial GPS, telling you how much money to move, what month to move it in, what day of the month to move it on. And we're going to calculate for you your interest savings so that you can pay off your debt, not with extra money, but with your current budget optimized to save you the maximum amount of interest per dollar applied. And our average client pays off in 7 to 9 years. But just to give you a quick overview, the P stands for prepayment of principal. You know that you can prepay principal at any time. You can put extra on your loans all by yourself. You don't need us for that. Okay. But isolating the principal amount means how much money do we pay and when do we pay it? Then we get into leverage. Leverage is the best leverage is to put the least amount of energy into something to get the maximum return, like a mechanical advantage, like a pulley system. What is the least amount of energy you could put forward to get the maximum return? So if I'm prepaying the principal, I'm isolating the principal amount as to how much and when, and then leveraging it, finding out what is the least amount to put down to get the maximum return, meaning I can save more interest per dollar. Okay, to give you an example of that, let's just say you can save $6 in interest per dollar when you're maximized. For every dollar you put on principal, you can save $6 in interest. Now, that's maximized. But if you don't know how to maximize, you would be satisfied with $3 in interest savings for every dollar because you wouldn't know the difference on how to maximize how much interest I could save per dollar. All right. But if you could save $6, why should you ever accept $3 for every dollar? So our system makes sure that you're saving the most anytime you make a move. And liquidity, that's the last L. Liquidity is understanding all of your money works, whether it is in your pocket, whether it's in the bank account, whether it's on a credit line. We're going to make sure that you understand the fungibility of money. Fungible, fungible, meaning that all of your money spends, but not all of your money has the same cost. We're going to show you how to make your money cost less. And I'm telling you, everybody right here, you can clip this, you can play it back, you can ask me questions about it all day. If you have debt, the most expensive money you have is the money sitting in your savings account.
So thank you, Ice. So does this only apply to the mortgage, or can you do it with like a car note or something else?
Any debt that carries interest.
Okay.
Any
So it's
debt
pretty
that,
much like
Mhm.
like how you in finance, like you do a value of money, like you do a discounting.
No, what you need to know is when you're borrowing money, you want to know how much does it cost to borrow money? Just like you would know if you were buying a television set, you would want to know how much it cost, correct?
Yes.
But most people do not know how much it costs to borrow money. So if you knew how much it would cost you to borrow the money, what if you could get it at 75% less without needing more money? Would that be an advantage to you?
Absolutely.
That's what we're talking about today. How to borrow money at a discount, how not to give all of that money to the bank. Now, here is what was happening in 1934, folks. In 1934, just coming out of the Depression, the bankers knew that eventually, if more people were able to purchase homes, they can keep them in debt for 30 years and make a ton of interest based on an amortization schedule where people would be thinking that 3% interest is not going to cost them very much. Anytime you have a 3% loan, folks, you're going to pay back 51% of what you borrowed to the bank. In other words, if you had a $200,000 mortgage at 3%, you're going to pay back $103,000 in interest to the bank. That's not 3%, that's 51%. If you have a 4% mortgage, you're going to pay back 71% of what you borrowed to the bank. If you have a 5% mortgage, you're going to pay back 93% of what you borrowed. That is a lot of money. Listen, let me break this down even a little farther. Let's just use $100,000. Borrowing $100,000 for 30 years at 5%, the bank wants $93,000 interest on a $100,000 loan. How's that 5%? Amortization does that. If you have a 6% mortgage right now, and that's where we are at 6%, on a $100,000 loan, you're going to pay back $115,838 interest over 30 years. You're going to pay back more in interest than you borrowed in principal at 6%. So what we're talking about, sir, is how in the world we can do all of this. If you're supposed to pay $115,000 interest on this loan, we can show you how to do all of this and pay about $25,000 in interest instead and not upset your financial apple cart. You can still go on vacation. You can still live well. We're going to show you the math involved and how not to pay all of that interest to the bank. Because if they can turn a 3% loan into a 51% loan, if they could turn a 6% loan into 115.838%, we can show you how to borrow money at an effective interest rate of around 1% or less, just using math, not magic.
Thank you, Ice, because I love math. I love the numbers. So how do I get more information on this?
All right, you can go to ice10k.com and then you'll see a button that says get a savings and earnings report. And then you will know the month, day, and year you'll be debt free. Everyone must fill out the financial form to become a P.I.L.L method client. Somebody online asked this question about what we're doing here. They want to know, how much does your service cost? Okay. So our service cost depends upon what we're doing for you. Anybody who fills out a savings and earnings report, they will get the cost along with it. We have people who have $80,000 in student loans. We have financial investors that have $2 to $5 million in commercial property. Well, these two people are not going to pay the same thing. So to find out how much it's going to cost, go ahead, fill out the information, and you can know the month, day, and year you're going to be debt free. And you can know how much interest you're going to save. And you can find out what it's going to cost you to get started. Now, here's what you're going to also learn. If you could save more in interest that you don't have to pay the bank, then the program doesn't cost you anything. The program costs you nothing. We actually asked this question in the beginning. If I buy $10 worth of apples and I sell them for $20, did the apples cost me anything? And everybody said no. If we can save you to $150,000 in interest, and we get a small fraction of that $150,000 as payment for the program, did the program actually cost you anything? The answer again is no.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.